My name is Wale OKUNRINBOYE. I work with the investment team at Sigma Pensions. My job entails finding assets that will deliver value tomorrow, today. A lot of pension fund assets today are deployed into bond instruments. A bond is an investment instrument typically issued by a company or a government, which essentially is a promise to pay back a specified sum at the end of a particular period at a given rate of interest. So for example, if the federal government of Nigeria issues a bond of 100 billion naira, it is a promise essentially to pay bondholders 100 billion naira at the end of a specified period, say maybe 5 years, at a specified rate of interest, say maybe 15% or 14%. Essentially, a bond represents a fixed promise to pay back a specified amount over a specified period. It varies from an equity or a variable income instrument whose return profile over a specified period varies and is not predictable. The key advantage of bond assets over other asset classes are that they guarantee a steady, predictable cash flow or payment pattern to whoever is a bondholder over a specified period. Companies typically, as well as the government, may avoid not going directly to a bank to borrow money. I mean, as I said earlier, a bond is essentially a borrowing, is a loan or a debt essentially by one person, promising to pay whoever agrees to lend him that money, who is an investor, a specified amount of money. Now, why do governments or individuals or companies go directly to issue bonds as against going to borrow from a bank? Is it typically a function of two things. Firstly, it could be either the size of the issuer is so large relative to the lender that it just doesn't make any sense. For instance, the federal government of Nigeria borrows an amount in excess of 800 billion every year from bond markets. There is no bank with a balance sheet that can single-handedly carry all that risk on its own. So clearly, there's a size problem in the sense that not one bank can single-handedly fund the federal government just because of the size of the federal government's borrowing pattern. Most banks typically will not be able to accommodate or to lend to one issuer that huge sum of money. The second reason why people typically approach bond markets directly as against going to a bank is the possibility of getting a lower rate of interest. Now, typically, most bank loans in Nigeria today, depending on the size of the issuer or the quality of the borrower, typically go for anywhere between 15, 16, it could be as high as 20, 22, 23, 25%. However, if an issuer directly goes to the market, he has the possibility of him getting a lower rate of interest. So going directly to issue a bond as against going to a bank provides the borrower an opportunity of earning a lower rate of interest, of borrowing at a lower rate of interest than he would get in a bank. So in simple terms, whilst a bank would charge you maybe say anywhere between 20-21%, you could issue a bond at 15-16%. So the savings on that is one of the reasons why issuing bonds are attractive to going directly to a bank. Although bonds are a fixed income instrument in the sense that they guarantee to a large extent to pay back whoever is an investor in a bond a fixed return, they are not infallible, or it's not an instrument that is without risk. There are risks to investing in bonds, and the biggest risk to investing in bond instruments is credit risk, which is the risk that whoever was the borrower may default or miss payments to whoever is the investor. So take for instance, a company has issued a bond of about 10 billion naira for a 10-year period for a project. At the end of the 10 years, the company, however, is unable to pay the 10 billion naira back to its investors. So clearly, for investors, they stand to lose their principal. And that's the biggest risk associated with bond investing, is credit risk. So one of the things we do at Sigma is to try to undertake a very rigorous process to ensure that whoever we're investing in, whichever bonds we're investing in, we assess the credit risk of the issuer to a large extent to ensure that is an issuer who has very low risk of default. The second risk associated with bonds is interest rate risk, which is the risk that if you invest at a bond, say for instance I invest in a bond that's issued at a yield of 10%, and in the future interest rates, which are constantly moving around, rise to maybe say 15%. If I invested at a 10% on a 5-year bond for 10% at 10% yield, what that means is that I lose the opportunity of earning a higher rate of interest over that period because interest rates have risen to 15%. So the other risk we are associated with investing in bonds is interest rate risk. Now, typically, when interest rates moves against a bondholder, the price of that bond, or there's a higher discount applied to that bond by other people who possibly may buy that bond instrument. And so typically the second biggest risk associated with bonds is interest rate risk. And also there's an inverse relationship between bond prices and interest rate. Interest rate rises mean the price of a bond declines. How do we select the right bonds to invest in?